All righty. Welcome, everyone, to tonight's Monday macro update. Another Monday macro update twice in a row. It's not usually like this, but welcome, everyone. Hope everyone is having a fantastic weekend so far. I guess it's Monday now. Seems like the weekend went by fast. Did a move this weekend, so new place, kind of still getting unpacked here. So we have a pretty good show for you guys here tonight. I mean, there's a lot of stuff to get into, and I really was having a hard decision on what to cover. So I pretty much stripped it back to the main three things that we're looking at here coming up to this week, but still another pretty impactful week. Not as much as last week with inflation as well as the jobs numbers, but we'll be getting into a lot of that stuff here this week. But pretty interesting signal, right? Back to this no landing cycle where we get let me actually pull up my Twitter account here. Back to this stop go no landing cycle. Here we go. There we go. Yeah, so I posted this back in November of last year, but really we've been going through this ever since the beginning of 2023. And this is the no landing stop go cycle where we enter periods of optimism and pessimism that is in transition with whatever inflation expectations are, because really that is what the Fed policy expectations will be based on what inflation is doing, right? Or the labor market. And yeah, you really have an interesting position where you have a Fed who is more and more split on their decisions. Some hawks are focused on still the persistent super core inflation. And then also you have some doves who are more so focused on the labor market, right? So, part of this dual mandate of full employment or stable prices, well, that dual mandate is, splitting a line down the middle of some of the Fed board members, which isn't really what you want to see. You want to see more cohesion and things like that. But yeah, as you get more of a lean towards one side, right? So let's say you get lower inflation plus a weakening jobs market, then the Fed might be more inclined to cut interest rates. Whereas on the other side, if you have more persistent inflation and then also you have a labor market that's stabilizing, well, then you'll get more. Oh, apologies about that. I think I had sound on the live stream though, so I have so many controls here on my computer, so apologies about that. Um, for those that are watching the live stream for the first half, I was on mute on the Zoom for the members, but what I was essentially saying was we continue to in this back and forth scenario where you get higher or lower inflation expectations or more of a strong or weakening labor market. And so this is what brings up this no landing stop go cycle. And over this past week, when you got lower inflation but also more positive jobs numbers, which we'll get into here in a second, that pushes more towards hawkishness, which the market does not like. And it's perpetuating a lot of these outflows out of the mega cap stocks and into more of the real economy sort of thing. But we'll get into it here in this discussion. So, for those that are joining on stream rather, the way that these Sunday or the Monday macro wrap up, usually they're on Sunday. How they work is they're an hour long. The first half or the first 30 minutes is streamed online for everyone, and the second half is offline for our Macro Optics members, where we will be getting into some more ideas and all the information they're about to cover. We're going to be getting into more so how to actually act on all this data that we're getting, right? Because it's not just enough that you get a bunch of data, right? Because if you're not doing anything with that information, then what good is it? So, part of the reason why we created macro optics is to cut through a lot of the noise that's out there and really just focus on what matters, because the mainstream media, if you go on like Fox Business, CNN Business, CNBC, all those different like financial or Wall Street publications, they're mainly just to entertain. They're not necessarily to give you actual ideas. Notice they never use math. They're always talking about what the narrative is, and that's not necessarily how you want to invest, right? It's pretty entertaining, that's for sure, but that's not how you actually want to approach the markets. So, um, also as well, we're still talking a lot about the new website here, as well as our couple of memberships. Check out the 6-week challenge. This is a six week execution accelerator for people that might be you might find yourself just inundated with so much information that you have analysis paralysis, and you want to learn an actual process on how to take all that information or the best parts of it and put it into action. So that's what we do here, and we start with the math of the macro and go from there. But if you guys want to check that out, there's a link in the description below for those that are on YouTube. For those that are on TikTok or Instagram, you can check us out in the link in the bio there. So let's go ahead and get into some of the data from last week. We had a pretty interesting drop in retail sales. Whenever you get data, though, what my team and I like to see is at least a few months of a confirmed trend. That's the month over month. Here's the year over year. So in terms of retail sales, we can see that we've had about, from the August 2025 peak at 5%, we've had a pretty stark drop all the way down to the December number, which is 2.4% growth, which is essentially half. And for December, though, this was a pretty big swing downward, right? So if we take a look at December's from, let's just say 2024, it was double that, right? And then, yeah, December of 2022 was at 5. December of 2023 was at 5.3. So, over the past few years, this was the lowest December um, retail sales number. And I think that's just a testament to the K-shaped economy widening, and the majority of the growth actually coming from government stimulus and not necessarily income growth or actual, um, real tangible consumption, right? So that's what was last week. We also got the non-farm payrolls, which had a positive headline number, right? When we take a look at that, it mostly came from private jobs, which is positive. But then we had some revisions that happened, and it was nearly 900,000 in negative jobs or revisions for the year of 2025, which is like, okay, how can you say you have a strong economy when you had the largest negative jobs revision for the year in United States history? Or at least going back to like the Great Depression. So it really points to this entire shift that we're seeing in the markets where, in terms of the labor market, you have people not hiring. You have the fiscal policy of cutting off a lot of immigration, right? So immigration is net zero, meaning that any type of population growth or jobs numbers is solely based on native population, which, the native population birth rate has been declining pretty much since 2008. and it has been negative pretty much ever since then. And then also too, you have a large amount of retirees happening over the past few years, right? So people who are 65 years or older effectively retiring, meaning they are no longer in the um, the labor supply at all, right? So the actual pool of labor is shrinking, and you're getting hit from all sides with that. And so I think partly the negative jobs revisions were due to that huge supply shock in the labor market that we're seeing. Because a lot of people talk about labor market demand, but not necessarily labor market supply. And I just think that we're at this point in the major market cycle where, or in this late stage, I don't know, capitalistic society where you're just getting more of a nationalistic viewpoint as well as a rip the band-aid off of what actually the population growth is underneath the hood. And so I think that's really the story when it comes to um, the labor market. I think it's more of a supply issue. And so maybe it is normal now to have some of these larger negative revisions, maybe that is the new normal until we can restore a lot of things. So, um, oh yeah, as well as the AI boom, right? A lot of people are using AI to be more efficient. A lot of companies are doing that. Still though, the unemployment rate, because of all of that, because of the supply shock, even though demand is also crap, because supply is crap, you also have a low unemployment rate, right? Because the calculation for the unemployment rate is the total unemployed population divided by the total labor market supply. And so if you just think about that for a second, if you have the numerator dropping as well as the denominator dropping, which one is dropping fastest? The denominator is. And so you get a lower number, right? Or I'm sorry, the numerator. And it's not even counting people who are no longer in the labor market, right? So it's an artificially low unemployment rate. That's the takeaway. Existing home sales fell to the most in 4 years, -8% year over year drop, which is quite substantial. Pretty large drop. And then we also got the CPI number, which headline inflation did slow to 2.4% for the month of January. Core inflation also dropped to 2.5%. You had some things, some components that remain relatively sticky. So, this was a lot to do with, energy. But yeah, I mean, you still had that pretty large deceleration there. And yeah, so when you have the inflation rate coming down and you have the labor market that looks like it's stabilizing, um, then you're going to get a more hawkish viewpoint from the market. And so that's part of the reason why you had, a negative 1.1% S&P 500, nearly 100 basis points in the negative for Qs. And you see a continued acceleration in a lot of the real economy sectors like energy, materials, industrials, um, things like that, or consumer staples, things like that. And yeah, we can just take a look at some of those viewpoints here. And for those who are looking at the background, the color is yellow because the S&P 500 just went neutral last week. And so that is pretty interesting. The Qs are negative, but small caps still remain bullish. So that is pretty interesting there. And a lot of things broke in the Mag 7. So in talking about the top 10 or the Mag 7 stocks, Apple bearish, Meta bearish, Amazon bearish, JP Morgan bearish, Broadcom bearish, Tesla bearish, Microsoft bearish, Google just went bearish. The only thing that's remaining really is Nvidia, which is now neutral. And so you no longer have anything in the top 7 in the Mag 7 that are in bullish trend anymore. Of the top 10, though, Walmart continues accelerating higher, which is pretty interesting considered, in the consumer staples camp, which if you take a look at a chart of XLP, that continues higher. The new sector that just had a huge breakout, which we talked about last week. What is utilities? Massive acceleration over the past week. Um, Same with real estate. Those are the new emerging trends. Healthcare is starting to weaken a little bit, but it still remains in bullish trend. Industrials, energy, consumer discretionary is bearish. Materials is bullish. Consumers or communications bearish. Financials broke bearish bad last week on that flattening yield curve. And then tech is also bearish. So pretty much a flip from what we've been seeing over the past few years. And if this trend continues, then we might see some more pain in the markets. We shall see. But there's definitely a lot of bullish trends to still take advantage of that you're not really hearing too many people talk about. There are some, including this channel. But yeah, gold remains bullish. Silver's is neutral. We like how gold volatility continues its downtrend there. Interesting how last week we saw a little bit of a breakout in the MOVE index, which is bond volatility. So we're going to keep an eye on that. Could be something similar that we saw back in late November before it ended down even more. But typically, bearish bond volatility is good for the underlying credit market conditions. The VIX did close above 20, though. So I'm seeing that, not necessarily huge buy the dip moments in a lot of things. This is a good trading environment usually, but we just want to see what happens from here. I mean, obviously, just looking at the VIX, it's been trending up. So, got to watch out for that. Yeah, and then because of this huge risk off signal, things like bond ETFs like TLT, as well as IEF, having huge breakouts right now. So these are bond ETFs. And then also the dollar still remains in bearish trend too. Bitcoin had a little bit of a pop, but still remains in bearish trend. Had a decent bounce last week, but yeah, still remains in bearish trend. So pretty interesting shift back from soft landing to a no landing camp. Now from here, when you get some lower inflation expectations, if we also get a little bit of fear in the labor markets, which we could see that, and we go back into this go phase, which is where you get a more dovish Fed instead of split down the middle. Maybe you get talks of further rate cuts happening sooner rather than later. Typically stocks like that. You get a capital flow back into mega caps, and then you get more of a soft landing optimism. And then once that starts to bubble over a little bit, and then inflation expectations are higher, then we go right back into this stop phase, and around and around we go. Now, interestingly, since 2023, being in this cycle, look what the market's done. It's had a lot of it's been mostly up, right? So shouldn't be too worried about this. Typically, it has been buying opportunities, but you definitely don't want to be catching falling knives. You want to have exposure to things that go up. And then once you start to see, less bearishness happen, that's a great time to buy. So yeah, a pretty decent week in the down with the S&P 500 major stocks. Let's see. Yeah, when taking a look at the classic momentum indicators, and this is looking at the S&P 500 on a longer time frame on the weekly, you can see how it's starting to top out a little bit on some of these momentum indicators. Now, this is purely momentum. This is not looking at volume or anything like that. But sometimes it's good to pay attention to these momentum indicators, especially when they're peaking and rolling over, or troughing and starting to signal an uptrend. Last time we saw an uptrend was back, in June or late May of 2025. This indicator here is the MFI, money flow index. Highly recommend. But as you can see here, we're starting to get some red dots. And if this turns over, that's something where you want to be a little bit more cautious in terms of like trying to bag hold for a longer period of time. And then when you look at some of these more classic momentum indicators, such as um, the SMI, the RSI, right, stochastic RSI, you can see that they're a little bit peaked out, looking like they're about to come down a little bit more. So that's looking at a more of a longer term time horizon, though. So I wouldn't be surprised if we do see some further sell off from here. But yeah, that's pretty much what I'm seeing. In terms of the yield curve, though, we saw, because of all this fear, we saw what's called a flattening, which is where you get more economic fears over optimism. But what's interesting is that it was just steepening and now it's flattening, specifically going from a bull steepening to a bull flattening. And this is what's called on our book a phase 12 yield curve transition. And this has happened in the past, namely in 2010 through 2012, 2015, and late 2023, which typically we saw after aggressive easing from the Fed, as well as a yield curve steepening. Long end yields roll over as growth disappoints, while short rates remain pinned. That's like exactly where we're at right now, because you have fiscal dominance with them pinning the short end of the curve, and then long end yields have been having a pretty decent correction. Market shifts from reflation to stagnation. Recovery stalls despite the Fed's help. The economy can't get going. Not sure if that's going to happen. But yeah, stocks can chop for months. The winner is typically long term bonds, gold. But what's interesting is that with this week coming up here, we get the preliminary estimate of the Q4 GDP, which we already, probably already know is going to show an acceleration. So forecast is 2.8 though. So we'll see what happens. We could see a downward surprise on growth, which would perpetuate more of what we saw last week. So still, that's going to be a little bit volatile around there. You also have core PCE prices, which is the Fed's preferred inflation gauge. That is on Friday at 8:30. Then you have a couple other things, but it's mainly just core PCE on Friday, the preliminary GDP report for Q4, which that's annualized. So when the Q4 number comes out, it's not like just for September or October, November, and December of 2025. It's annualized. So it's the final report of the entire year for 2025. So that's pretty important there. Um, and then we also get the Fed minutes on Wednesday. So that's pretty important. Nothing major tomorrow. And so, with a lot of the fear that was happening last week, though, I wouldn't be surprised if you get a bit of a reversal, and you kind of saw that on Friday a little bit. But it might provide a buying opportunity for a lot of the things that have gone up for a while. So that's what we're seeing here. But let me just go over my notes here, make sure I covered everything. Yeah, so I mean, I'm going to be continuing to look for opportunities, especially with some of these new emerging trends, right? Obviously, not going to be buying things like XLU because they just, or buy anymore because they just ramped up way above the top end of the trading range here. You do not want to chase this, even though it looks promising. Never chase, never chase. Let the opportunities come to you. Now, there might be some single stocks within the utility sector that might be providing some opportunities. Maybe we'll cover some of that here once we go offline. But yeah, that's what we're seeing here. Materials, energy, industrials, staples, all these are trends to look out for to have in your portfolio while we see this capital rotation out of the mega cap tech stocks. So let's take a look at some of the big movers as well last week. Just some call outs here. South Korea continues to rip. One of the better performers from last week. You see, you don't have to just invest in stocks or even commodities or crypto. There's also country ETFs, right? So just like how the United States has the S&P 500, other countries that have their own, um, you know, stock markets, exchanges, things like that, you can invest in those S&P 500 versions of those countries also, right? And if they're bullish, then there could be a great opportunity, especially with this capital rotation. South Korea being one of them that was continuing to do well. We were talking about gold miners and gold over the past couple weeks, and those have had a pretty decent bounce. Was selling some of that last week. What else here? Silver miners as well. They look a lot better than silver. Oil just continues to rally as well. So oil prices, oil and gas equipment and services ETF XES was one of the better performers. Some of the worst performers last week, natural gas. This thing just keeps on flip flopping. That one's a hard one to trade, especially the ETF UNG. But that, as well as unfortunately, Apple. Look at this huge breakdown from Apple. Man, that's a whipsaw right there. But with something like Apple, again, this is what was it, a $4 trillion market cap, 3.76 trillion. For it to whip moves like that, looking like a cryptocurrency, that's a huge signal, you know. So that was pretty interesting, as well as when you saw this huge breakdown in the financial sector. So this was on our list last week on it for a potential breakout, but it completely just rolled over. And so that's why you don't buy on these, especially if you take a look at a chart of volume. You had a little bit of a drop off in volume before this acceleration here. So you got to pay attention to those bearish and bullish divergences in volume. And then Bitcoin just continues to not figure it out. And one of the charts that I usually like to point out is the net central bank liquidity chart, which still remains around 2 trillion. And without any more money in the RRP, I mean, this thing just continues to drop. But a lot of the funding is coming from the Fed now, which they claim that they're not doing any type of quantitative easing, but they technically are. Right. It's just not the classic quantitative easing that you and I think of when we think of like, COVID injections, 2008 financial crisis, that type of thing. That, and because the government continues to go further and further into debt, as well as the obligations that it needs to meet for a lot of this larger deficit rollover that we see, right, with them issuing treasury bills to fund the government. And the analogy that we've been, talking about over the past, whatever, couple of years now, it seems, is this huge credit card that the government has where instead of them, paying off their card every single month, they're taking that, they're taking out a new credit card, paying off the old one. And then now it's just a larger limit. And then they max it out. And instead of paying it off, they open up another one and redo that, right? Now the government can do it because they're the government. If you and I did that, that'd be fraud and we'd be thrown in jail. But rules for thee and not for you and me. And yeah, so the story with that is they have to keep more cash in their checking account. It's kind of similar to normal everyday things, right? If you think that you have some larger debt obligations coming up, well, you put some more cash in your account that you would normally carry. That's exactly what the government is doing right here. And this is all in all saying that liquidity isn't as abundant as even the credit markets are saying it is. And what tracks this very closely is Bitcoin. And so Bitcoin understands this liquidity dynamic, this poor liquidity environment really well. And it's doing what it's supposed to do when liquidity is tightening and not expanding, or expanding at an accelerated rate because the real economy is not doing well. So take Bitcoin right now, not to invest, obviously, well, not financial advice, but more of a macro signal that liquidity is, tightening right now. But yeah, that's pretty much all I have for the stream. It's 8:30 right now, Eastern time. We're going to go ahead and go offline for the second half of this. And so, for those who are joining on stream, if you want to, check it out, you can go ahead and go to our macro vision tier, where you can get access to the Sunday macro wrap up, the full one with a 7-day trial of that tier. And then after that, it's $49 a month if you choose to stay. But yeah, we're gonna go ahead and go offline now. For those who are on the Zoom call right now, stick around. We'll say bye to social media, and we'll catch you guys in tomorrow's daily macro update. Bye, everyone.